Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day, which comes from Lance. Alan, I'd love to know your thoughts on dividing a covered call position by selling half in the money and the other half out of the money. Example, I own 1,000 shares of SPY at $95. Sell the $90 and the $97 strikes, 5 contracts of each. This method seems to give the investor the best of both covered call writing positions. And it's signed Lance. Well, Lance, you're absolutely onto something here. Using only in the money or only out of the money strikes is usually reserved for extreme market conditions. We use in the money or favor in the money in bearish or volatile market environments, and we favor out of the money in bullish market environments. But frequently the markets are normal or somewhere in between the two extremes, in which case we would use some in the money, some at the money, perhaps some at the money. And I refer to this in my books and DVDs as the laddering of strikes. So let's first have another look and review the moneyness of the strikes and the advantages and disadvantages of using each one. Now, as you could see on the screenshot in front of you now, the in the money strike is the most conservative of all the strike prices we could use. We use it in bearish or volatile market environments and when we have concern. Also, even in normal market environments, when chart technicals are mixed rather than all bullish and confirming, we might want to have some in the money strikes in our portfolio just as a form of protection. Now, the at the money strike, an example is you buy a stock at 50 and agree to sell it for 50, gives us the highest initial return, but gives us no opportunity for upside potential from share price appreciation. And it gives us no opportunity for downside protection of the entire initial profit. There's always a break even, which is the price of the stock at the time the trade was entered minus the entire option premium. And that's a bullish position. Now, finally, the out of the money strike, example, you buy a stock at 48, agree to sell it for 50, is the most bullish of all the covered call writing positions, and it allows us an opportunity to generate 2 income streams in the same month with the same cash on the same stock. One from the sale of the option and the other from share appreciation from the value of the stock at the time the trade was entered up to the strike price. So an opportunity for 2 income streams. So there are the advantages of each of the strike prices. And you could see when it's a normal market environment with the normal whipsaws we're having, that we may want to go with some in the money and some out of the money. And by the way, posed in your question was 50-50. Doesn't have to be, because you may be a little more bullish than just in terms of your overall market assessment. So if you hold 10 contracts and you're slightly more bullish, you may want to make that mix 6 contracts out of the money to 4 in the money, or 7 and 3. So you're not married to a 50-50 situation. Let's take this another step further now and have a look at the laddering of strikes. And just to review, what we've talked about thus far is that in a raging bull market, we're likely to go almost 100% out of the money. And in extremely volatile or bearish market environment, and when chart technicals are mixed as opposed to fully bullish, we're going to favor almost all in the money strikes. Most of the time, however, the market assessment will be someplace in between, in which case we could ladder the strikes and use a combination of out of the money and in the money strikes. So let's take a real life example, one of the stocks that frequently appear on our premium watch list, a very popular stock, Starbucks. At the time that I made this screenshot, you could see that Starbucks was trading at 57.12. Now we're going to have a look at the in the money 56 strike below the current market value, and the out of the money 58 strike above the current market value. Both expired on 10/23/15. These are 1-month returns. Now, as far as the in the money strike goes, you could see that the initial return on option, or ROE, is 1.6%. That's below what we normally ask for or look for but still annualizes out to about 19%, so it's not so bad. But we could see that 1.6% is protected by 2%. That means the current market value of the stock can decline by up to 2% by expiration Friday, and we still will have been guaranteed that 1.6% 1-month return. Now looking at the next row down, the 58 out of the money strike generates an initial return of 2.4%, pretty good, and an opportunity for another 1.5% if the price of Starbucks moves up from 57.12 up to the 58 strike. So there are your two income streams, giving us a possibility of a 3.9% 1-month return. So Lance, there you have it. You're definitely onto something here with mixing up strike prices. There's no law that says when you're using multiple contracts per position that they all have to be either in the money, at the money, or out of the money. We could mix it up, and I do that all the time. So it's important as an investor and as a covered call writer to understand what your overall market assessment is, your evaluation of the chart technicals, and your personal risk tolerance. And again, the more bullish, the more likely you are to favor out of the money. The more bearish, the more likely you favor in the money. And certainly a mix of those is warranted and justified pretty much every month of the year. So Lance, thank you for the opportunity to allow me to discuss this topic. Again, it's very, very important. And of course, I want to thank all those out there viewing this video. I hope you enjoyed it, and more importantly, I hope it makes money for you. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.